Hey, Carley, thanks for being with us on Stock Shotz again.
No problem, James. Glad to be here.
Carley, we had been having some hope, or at least in my opinion, the markets were showing us a little hope, and then Friday we had a pretty bad-looking day. Futures are up right now, but what do you anticipate this week?
You know, honestly, I kind of considered Friday as like a win for the bulls. The market had every opportunity and, quite frankly, every reason to completely melt down, which is what we've done on the previous 2 or 3 bear market rallies, and it didn't do it. We held relatively strong. On Friday, I was a little, I was questioning whether or not some of the market holding up was it, real, or was it simply option expiration and futures expiration and all those types of things artificially holding it up. But looking at overnight trade, things are looking pretty good. Honestly, I think that this week carries a lot of event risk. We've got, supposedly, we're supposed to hear the details of the government's plan to buy toxic assets tomorrow, and then we have Bernanke and Geithner speaking on Tuesday. We also have President Obama speaking on Tuesday, so it's going to be an eventful week, and I think a lot of the shorts are kind of second-guessing themselves at this point, so I think we're going to get another wave of short covering. Could bring us back up to like the 800, 807 area in the S&P, but from there I'm a bear. I'm not sure, beyond that point I'm not sure how much momentum we can gain, so we'll see.
Now, I know you watch the Treasuries and you look at bonds. You could find different opinions all over the net after the Fed, the bonds, said they were going to inject $1.2 trillion into the system. And, we've had guests on the show like economist John Williams who refer to that as simply monetizing the debt. Mm-hmm. Tell me how that impacted last week and what impact that could have on a go-forward basis.
Well, Treasuries, obviously, the reaction was pretty volatile. At one point, the 30-year bond futures were up 8 handles in a single trading session. I've only seen that one other time, and that was back in the, in the fall when the bond market really started to move. So definitely extraordinary times. At this point, honestly, I think the Treasuries actually have some room to move on the upside. A lot of the rally that we saw late in 2008 was on anticipation of the Fed coming in and buying the longer-dated maturities. Now that they're actually putting their money where their mouths are, I think we could get some follow-through. Essentially, what they're doing, it's basically, in a nutshell, they're printing money, and the longer-term implications are extremely bearish for bonds. But with that said, the next maybe 2 weeks to a month, I think we could get some follow-through buying and, more importantly, follow-through short covering, because this is another market where a lot of the speculators, especially the small speculators, are heavily short. And, the Fed has much deeper pockets than any of the speculators do. So. Well,
and that was one of the things that I thought about it, and I had really looked at the TBT is an ETF that's short the Treasuries, and I thought that you've heard so much about the bubble bursting that if you got any action like this, there were going to be a lot of people that were going to get flushed out from the short side.
Right, and that's exactly, I'm not going to say that we predicted this because no one could really predict what we saw in the last week or so in bonds. But, anyone that reads my newsletter, the Bond Bulletin, we warned of something like this. The market had been eerily quiet, and bonds are it's the type of market that doesn't stay quiet for long, and so we knew there was going to be a sharp breakout one way or the other. We also had pointed out there's just too many bears. Like you just mentioned, the short ETFs are popping up left and right. Anytime that you see a market, like if a market's getting enough hype that they're creating ETFs to benefit from that hype, a lot of times, you're late to the party at that point. So I kind of had a sense that there's just too many bears, too much bearish sentiment, and something like this could happen, and it did. And along with that theme, I think it could continue for the next couple of weeks.
How will the dollar, if it starts to fall back, impact what your outlook will be for Treasuries? Will it have any bearing on the Treasuries at all?
It will. I mean, as the dollar continues lower, I mean, in the long run, it is going to have a weight. It will add some selling pressure to Treasuries. With the idea being, I mean, foreign investors, namely China, as the dollar's depreciating, they're seeing their investments depreciate because they're very heavily long the dollar in terms of buying U.S.-backed securities. So that will, at minimum, prevent some foreign buying and will have a negative effect on treasuries in the long run. Short run, I'm not so sure the market's going to really pay attention to that quite yet.
Do you think that China has a vested interest for the reasons that you just stated in keeping the dollar up and not really pulling all of their money at one time? Because if they did that, obviously it would cause the dollar to cascade down. Do they have a vested interest in that, or will that not come into play?
That's an interesting point. Obviously, they do have a vested interest. At this point, China's not in panic mode by any means. They're sticking to their guns and holding by their investments, but they are starting to get a little bit nervous. So, I think that they're, wise enough not to pull the plug all at once. And even if they do start pulling a little at a time, we're definitely going to feel the effects of it. There's no doubt about that.
Well, let me ask you this. I know that you talk to traders all the time, and one of the questions that's been on my mind is, does the street really have any confidence in Geithner? It looks like they have absolutely none, because it seems like every time he talks, we go down. Is that overblown in the media, or is that really the feelings of the traders?
Just based on my conversations with people within the industry and clients and things like that, so far Geithner hasn't really lived up to his expectations and many of the expectations that Wall Street had for him. So I guess the answer to that would be no. I think the confidence levels are very low. He can. Hopefully he can come out in the next week or two with his plan, the toxic asset plan, and change things. But for now, I think he has a long road ahead of him.
Does that plan have to be a home run for the market to react positively?
At this point, yes, I think that it does. And even if we do get some sort of a positive reaction out of stocks, once again, I'm not sure it's going to hold. I think eventually stock traders are going to, kind of digest what exactly the Fed has done with the quantitative easing, essentially printing money, things like that. And I think, people are going to kind of second-guess the buying. I call it buyer's remorse. So we could see 800 in the S&P maybe if Geithner comes out with a plan that excites everyone. We might even see 830. But from there, I'd be a big bear.
So if it got to 830, you would start getting short in a pretty big way?
I mean, up in the 830 area, that's on a chart. That's my weekly resistance area.
For the rest of this great interview, visit our website, www.stockshotz.tv. That's www.stockshotz.tv. Thank you for listening.